Following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint. Welcome to our weekly market deep dive for May 3rd, 2021. Well, starting as we usually do with commodities and the US dollar, you can see we've used monthly charts this week because, again, at month end, we like to take that longer term look and make sure we're on the right side of some of these important trends. Starting with the US dollar in the top left, you can see that the dollar is testing a very important area of support. Should this area hold and the dollar bounce, it could put a little bit of a wet towel on the reflation trade and the strength in commodities we've been seeing recently. Should it break, however, you could see substantial devaluation in the dollar and, again, an increase or a wind at the back of that reflation trade. The euro is up at a similar area of resistance, which is, again, just as important technically. But looking at the Bloomberg Commodity Index, you can see getting back through 75 and the strong reflation the market has seen over the past year. Center pane are the four commodity subsectors, which we like to look at, again, at least once a month. And you can see all four of them, whether it be energy, base metals, agriculture, or the precious metals, have all broken some form of downtrend line and are seeing some important strength. The big winners, as we noticed over the past couple of weeks, have been the agricultural sector. Corn, for example, was up 10% last week and 12% the week before. Even with that strength, however, you can see what a punishing long downtrend the agriculture sector has been in, and that it still has a long way to recover before you can really start talking about inflationary forces being built. You can see the corn chart here in the bottom right on a weekly basis, and also strong last week was copper, which is here the second one down from the right. Again, copper's at a 10-year high, and it usually is only demand for raw materials and building materials and true economic activity that pushes copper to new highs. Digging a little deeper into crude oil and gold, you continue to see some positive developments in the crude oil market. We have the 1 and 12-month forward contracts of Brent crude on the left, along with the spreads between them in the bottom pane. You can see that the spread is in positive territory, meaning the near-term contract is more expensive than the further dated contract, which is contango, or a healthy market situation or dynamic. Technically speaking, crude oil, at least the Brent crude contract, has gotten up through key resistance around the 60 area, broken a trend line, and is really digesting those gains in an orderly manner. Very healthy market there in crude. Gold, on the other hand, is seeing a little bit more of a mixed message. While you've been in a downtrend, the downtrend may be reversing based on some of the technical indicators we showed on the previous slide, but they have yet to get through that downtrend you can see on these gold charts on the bottom pane. Additionally, we're seeing weakness in the 10-year spread compared to the 5-year spreads. So again, a little bit of a structural headwind for gold, whereas oil isn't seeing that. As for the fixed income market in U.S. Treasuries, the U.S. Treasury, 10-year Treasury, bounced off an important area of support last week in the 150 area, which you can see on this daily chart. The Treasury had seen a substantial rally in yields from 1% up to 175 over the past few months. And again, pulling back to digest these gains is normal and healthy action technically. Longer term, if you look at the weekly chart on the right, you can see that getting back through the 2019 lows, which were the same lows as 2012 and 2016, was an important development on the chart. It's like when the Bloomberg Commodity Index got back into this trading range, it was a sign of further gains to come. We think that's the case for the 10-year Treasury, and that it is confirming the strength in the copper market and commodity markets in general, and is likely to hold this 140 area as well, should it even go back down that far. Looking at yields globally, you can see on the right-hand pane that all the global yields that we track have been strong for almost a year now. The strength started with the 10-year US break even, which actually scored a higher high last week up to 241. It's a little difficult to see, but that is a higher high. And that's important because, again, it was the 10-year US break even that led off the COVID lows, that then pulled the 10-year US Treasury higher, that then pulled yields globally higher after that. So we do have a healthy yield curve, which you can see on the left-hand side, albeit a little bit off where it was a month ago. The dashed or dotted olive colored line is where the yield curve was a month ago. The solid green line is where it is now, slightly lower, but again, just a consolidation compared to the other dashed green and gray lines, which were 6 and 12 months ago. Looking at credit spreads remain healthy, and these are the spreads between corporate bonds and the 10-year US Treasury. If you look at investment grade corporate bonds, the spread is about 1.09%, which is down almost at an all-time low. Between high yield corporate debt is down to 3.28%, which is very close to the lows back in 2017 and 18 of 3.26. And interestingly, the CCC spreads of 501 are actually lower than what we saw in 2017 and 18. So again, yields continued or spreads continue to compress, which maybe you can argue is becoming a spring and they may bounce soon, but certainly no headwind for stocks. Usually credit signals weakness or signals us ahead of weakness in stocks, and we're seeing no weakness in credit spreads yet. So still a tailwind for stocks. Looking at the long-term chart of the value line, you can see the value line back to 2002 here. Again, with our favorite indicator on the bottom, which is the percentage of stocks within the value line index above their 200-day average. The key line here for us being this dashed 40% line. When you're below 40%, you're probably in a bear market. When you're above 40%, you're probably in a bull market. And you can see that indicator does a pretty darn good job of keeping you on the right side of the major trends. There are a couple whipsaws, but again, in general, it does a good job, all about a lagging job of telling you where you are in the market cycle. What is notable about the chart more recently is this indicator really has been pegged above 80% for months now, and it doesn't usually stay that strong for that long. So again, important strength longer term, and I do think we're in a market like the 1950s potentially, or the 1990s. But again, one that you can argue certainly is ripe for a pullback or some sort of consolidation or digestion. Looking a little more tactically at stocks, you can see on the daily charts on the left, the S&P 500 has now hit resistance at that 4,200 area a couple times now. It's, I wouldn't say fatal. I'm sure it gets through that area at some point, but you are starting to see market internals weaken. If you look at the RSI, an indicator of overbought, oversold, you can see a strong surge a couple of weeks ago, and then a lower surge below 70, which technicians call a failure swing. So again, that doesn't suggest the prices go to zero here or that you have a bear market imminently. But again, it does suggest that the momentum on the upside is waning and you're running out of gas. The number of new 52-week highs on the NYSE has remained strong, so no problem there. But if you look at volume, both up volume and down volume really have waned over the past couple of months. So if it feels like a market that is heading into summer, it really is a market that's heading into summer, particularly from a volume point of view, a very quiet market and one that's trying to figure out which way it wants to go. And potentially, you can argue, running out of gas. Another important divergence is the NASDAQ. As the NASDAQ has come up near its previous all-time highs, you can see the number of stocks on a daily basis trading at a 52-week high is far less than it was before. In fact, back in February, when the market made a new 52-week high, you had 600 stocks scoring new highs as well. Recently, only around 200. So again, not fatal weakness and not the kind of weakness that usually turns into a bear market, but certainly cause for concern in a market that looks like it wants to catch its breath. The weekly charts are showing the same healthy trends in the S&P 500 or on the NYSE with regard to market internals of breadth and leadership. However, on the NASDAQ, a divergence in the advanced decline line or breadth and certainly weakening leadership. So again, overall, a strong market, longer term, but over the short term, one that looks like it may want to catch its breath. As for market sectors last week, really kind of a weird picture. You had the majority of the sectors score positive gains for the week or finish in the green, yet the majority of the indices finish in the red. Really kind of a weird situation. The reason being it was the tech sector and the healthcare sector, which represents a lot of those larger cap stocks that pulled some of these indices down. Stepping back, everything looks okay from a trend following point of view and from a cycle point of view, in that the sector rotation that occurred at the market bottom a year ago was consistent with what you typically see at cyclical market bottoms, and cyclical market bottoms typically lead to a 2 to 3 year advance. The only other thing I'd want to know or note for some of you folks who are interested in the energy pad, one of the more attractive and interesting charts out there right now is in the XLE. If you look at the XLE or energy sector ETF, you can see that after being just punished for the past couple of years, the XLE bounced toward the end of 2020 and has had a strong advance this year. After getting through the mid-20 highs, it has pulled back to test that area and looks to be holding really like a champ. This is also a very value tilted sector. So if you believe in the value trade coming back, or if you believe in some rotation into some unloved sectors, energy stocks may be a great bet for you. Once a month, we also like to look at our canary stocks, or stocks we think that are usually canaries in the coal mine for the overall market cycle. There are 9 slides here, or 9 charts within the slide of various sectors. And again, they're all monthly charts. If you look at the top left, you can see the mid caps just below the small caps and just below those Dow transports. Again, very strong moves, and you can argue 6 to 7 months in most of these of making strong higher highs. So great strength and momentum longer term. It does argue for a continued bull market. Bull markets don't make V tops. But then again, are these sectors and groups poised for a pullback? You can't see it in the chart yet, but they're quite extended. And I would not be surprised to see some pullbacks start to develop in the near future. As for the volatility surface, there were some interesting changes in volatility in the market last week. If you look at the top 3 charts, you can see the vol surface from this week, the week before, and the difference. The axes across the different slide are time across the left-hand side, or the 4 axis, and then the strike price going backwards. And you can see that the spikes in volatility really occurred in the 1 month out of the money calls and the 1 month out of the money puts, meaning people were willing to pay more for out of the money puts with a 1 month expiration and out of the money calls with a 1 month expiration. This suggests to me that market participants are getting a little more nervous about the market, and again, willing to take bets out of the money to either protect their profits or place a speculative bet on the market to basically hedge some of these unknowns, whether it's COVID striking India or the Biden spending plan or something else is unknown. But again, what market participants are actually doing are buying out of the money short dated protection, but also bidding up out of the money calls as well. If you look at some of the sectors, you can see the 3 across the bottom of energy, financials, and value also seem to confirm that value trade that we were talking about a couple of slides ago and for the past couple of weeks. Again, the red line being put buying, or the skew in puts, the green line skew in calls. So when people are bidding up calls and not bidding up puts as they are in energy, similarly in financials and in the value sector in general, that suggests that any pullback here might be a move to value and maybe out of those large cap tech stocks that really have been dominating the action for the past several years. As for the overseas markets, we changed up the slides a little bit because, again, being month end, you can see monthly charts of the ACWI ETF, the EFA, and the EEM on the left, and weekly charts on the right. The real simple and key points being, you've seen 4 bear markets, over the past 10 years, which you can see highlighted in the green dotted lines on the top. And you can see that not only the ACWI, but the EFA and the EEM are at new highs over the past 10 years. So regardless of whether you call the breakout on a trend break or a breakout when you're at new high territory, the EFA, the EEM, and the ACWI are at all-time highs, which is great news. The weekly chart shows a little bit more of a mixed picture, however, with the All-Country World Index at a higher high, along with the EFA. But yet, like China, those emerging market ETFs have pulled back, but they're holding above their 200-day average. So again, strong trend on a monthly chart, pull back on the weekly chart. That looks like a consolidation range or a buyable dip, and maybe the kind of thing that might develop over the next few weeks and months in the US markets. A strong trend on a long-term basis and a little bit of consolidation to digest and catch its breath. Finally, regarding our COVID slide of the week, we like to show a few interesting COVID details. And most importantly is the A block on the top left, where you can see that the number of cases and the 7-day average of cases is declining and deaths are not increasing. So again, both metrics down dramatically, 75% or so off their peaks in January, and no real increase in COVID despite the calls for impending doom a month or so ago. What was interesting and a little bit discouraging is the top right, and that was a survey from the National Restaurant Association that is reporting that 1 in 4 restaurants list recruitment as their top concern, even over COVID. So while we all want to go out and go to restaurants, it certainly seems like restaurants are having trouble finding people to serve us. Hopefully that will change soon based on slide C or block C, because you can see that the US has now administered more vaccine doses than any country in the world, which is good news. And that's particularly good news because of block D. CDC is now tracking breakthrough COVID cases, which are COVID cases that people are getting after they are fully immunized, meaning 14 days past either the second shot or the first and only shot of a Johnson & Johnson vaccine, and they are extremely rare. In fact, 0.01% or 1 basis point of people who have been vaccinated are catching COVID. Only 1/10 of that are ending up in the hospital, and only 1/10 of that are passing away, meaning you have a 1 in a million chance of passing away on a breakthrough COVID case if you have been fully immunized. So despite the good news, one more concerning slide or data point on the bottom, which is while the influenza season has been quite light and not a tragedy for our children, thank God, as you can see by the chart to the bottom left, and this is deaths in children for different flu seasons, and the orange bars being COVID. So again, COVID has been a mild impact on our children. Still, quite a few states are not back up and running with 100% in-person learning. So in summary then, if you look at some of these longer term important trends, the US dollar again is testing the bottom of a very important range here down in the low 90s. If it holds, again, it could be one of the determining factors or the first domino to fall to start a correction in the US, which maybe is long overdue. If it breaks, however, you could certainly see an acceleration in the inflationary trends in things like copper, corn, across the commodity complex. The situation with yields is healthy. Yields have gotten back above the 140 area, which was a move on the charts. And again, they're pulling back and holding 150 like a champ. As for stocks, you're clearly in a bull market. You've been in a bull market for a year. They typically last 3 years, which is good news, and there's more innings to this game. That being said, you are starting to see some divergences in areas such as the NASDAQ that we talked about, where breadth and leadership is not nearly as strong as on the NYSE. That being said, again, the 5 charts or 6 charts on the right show our risk measures. And again, with strong copper to gold ratio, strong ratio of Dow transports to Dow utilities, a steepening yield curve, and strength in consumer discretionary stocks over consumer staples stocks on either an equal weighted or market cap basis. The background is in place for a continued bull market, and so any dip, if and when we get it, should be considered buyable. I've been Mike Hurley, Chief Market Strategist for NexPoint, and this has been your deep dive in the markets for May 3rd. Thank you for watching. We hope to see you next week.